All right, let's talk about housing. Well, is housing finally thawing out? But what does that mean for pricing? All right, I've showed this graph many times, and it's a very important graph because this explains why housing froze and why there were no transactions in housing. It's a good thing and a bad thing. During the zero interest rate environments of 20 and 21, what happened? Everybody rushed out and refinanced their mortgage. So the dark blue is mortgages with less than a 3% interest rate. The gray is 3 to 4. The salmon color is 4 to 5. The blue is 5 to 6. And the yellow is a mortgage rate of 6 or greater. Once people finance their house at those low rates, they weren't willing to sell. They're like, I can't sell, even if I want to sell, even if I want to get a bigger home, or my job's been relocated a farther drive, I'd like to move, my mortgage interest rate would double or triple on me. So people were frozen. As a result of that, you had no inventory, and all this millennial bubble were trying to get a home. They were getting married, they were having kids, they wanted to get out of apartments, and they were desperate. Values shot through the roof. They went straight up. Of course, people were able to finance at exceptionally cheap interest rates. So housing values absolutely exploded. And we went beyond the median home price to household income than we were at the peak of the housing bubble. The unfortunate thing about that is, do you know what the average age, well, you can see it, it's up there. Average age of a first-time home buyer today, 40 years old. Think how sad that is. You know, when I bought my first home in 1992, I was in my late 20s. Most all of you who are in my age range, we all bought our homes in our 20s or our beginning of our 30s. Heck, even as of 2000, the average age was 31. But homes just got priced out for the younger generation. But now inventory's adjusting and pricing's adjusting. Pricing has been coming down very slow. The median home sales price got to about $450, now it's $410, and inventory starting to move up. In fact, a pretty good move up in inventory. And I think we're going to continue to see that move up in inventory. For the obvious reasons, the 3 Ds, default, death, and divorce, job changes, various things will drive that. And stress, no longer providing forbearance on all those mortgages. So I think inventory is going to continue to move up and pricing is going to continue to move down. Now this is a very interesting, this is every state what's happened to home values. Now what do you notice when you look at this? I'll give you 2 seconds. It's the states that were booming the most from home price appreciation are the ones now in reverse in the biggest way. Florida, Texas, Arizona, California, Colorado. I'm kind of surprised that Idaho hasn't turned negative because Boise certainly has. The gray states are down a little bit or flat. And interesting enough, it's the Midwest and Northeast where you still have housing appreciation. My state, Wisconsin. And in fact, in Wisconsin, a lot of the areas that have the greatest housing appreciation are these old industrial towns where there's just been zero inventory built for literally 20 years. So in saying that, I do think you'll see Wisconsin turn red, not down anywhere near what Florida or Texas or Arizona will do, but I think it will turn red. I think but for a few states will turn red by this point next year, and I think the red states will get more red. And this is a big reason, because most of you are thinking, yeah, but interest rates are falling. And if interest rates fall, and you hear it all the time, and real estate brokers love saying, if rates come down, then they'll support housing values and we'll be off to the races. That's not true. Why? Because it's not the rate, it's the payment. When people buy a home, they look, what is that total payment going to cost me on a monthly basis? Can I afford that payment or not? And the simple fact is, of the 76 million households, representing 57% of the 143 million households, think of households as a family, cannot afford a $300,000 home. Just 30% of households qualify to buy a $410,000 median price home. Therefore, to get a typical American to have a mortgage payment to income ratio at the historical level of 30%, housing prices would need both to fall by 15% and mortgage rates would need to come down by 100 basis points. And mortgage rates right now, when I did this, they were at 630, but they're probably 622 or something like that today. So they'd have to get down to a 5.3 with a 15% drop to get into that equilibrium point. All right. Now the younger people are going, what is this? Carnack's 10-year prediction. Carnack is, for us older ones, we know Johnny Carson was a famous skit he'd always do on the Johnny Carson, making his predictions. And that's me being Carnack. I'm going to make a 10-year prediction on housing. Now, who in their right mind would say, I'm going to predict what's going to happen to housing over the next 10 years? But I feel really confident about this one. Housing values will increase less than the rate of inflation, producing a negative real return on investment. That means housing will not be a good investment, where it's been a great investment over the last 10 years. So I fully expect 10 years from now, housing values will be up. Why? Because we're just going to continue to destroy the value of the dollar and create inflation. But when you factor housing appreciation against inflation, you're eating a negative real return. Now, why would I make that prediction? There's two reasons. One, COVID and zero interest rates shot housing through the roof. During the great housing bubble that started in kind of 04, you jumped up 20%, you took a pause, you jumped up another 20%, so it was an accumulated increase of 41%. Then we had a hard sell-off, and then over a 10-year period of time, because no homes were built during 08, 09, 010, 011, 012, housing values started to slowly increase, and then we started having home building, and they started to flatline right before COVID, and then COVID happened, zero interest rates, and they shot straight up 40%. Now they're off about 8% over the last couple years. But they're still way outside the historical tracking of inflation. If you look at the value of housing, it has always tracked the rate of inflation through our country's history. But there's another reason, an equally big reason. Because one thing you'll learn when you deal with economics, demographics are a huge, huge driver of economics. And what is the second reason? The baby boomers. Baby boomers were born in 1946, post-World War II. That's the first year of the baby boomer. And the last year was the year I was born, 1964. The baby boomers own the housing market. They're the biggest cohort, owning 32.1%. Many baby boomers own more than one home. But the reality of it is, over the next decade, us baby boomers will need to downsize. We're going through a change of life. They'll sell the second home, maybe the first home, maybe move into assisted living, and pass away. The simple fact is, the younger generation does not have the money to afford what the pricing of the baby boomers' homes are today. So you're going to have this wave over the next decade of baby boomers needing to sell and downsize with a younger generation that doesn't have the money to buy it. So I think you will see a slow grind south in housing values because of this dynamic. All right, let's look at CRE, commercial real estate.